Hello everybody and welcome to the Cyclical Investors Club YouTube channel. Today I'm going to be analyzing Salesforce Inc. stock. This one came in by request. If you have a request of a stock you would like me to analyze, just put it down in the comments section and I'll get it on my list and I will eventually do a video analysis of it. If it's in the S&P 500, I post those on YouTube for free. And if it's not, I post those over on Patreon, which is $5 a month. And if you join there, you get a big discount off my full service if you ever decide to join it. And we have all kinds of things there, like a chat room, spreadsheets, articles about strategy and things like that. So you can consider that. Those links will be down in the description. As always, this is not individual investing advice. This is just how I analyze stocks. So let's start by looking at Salesforce's historical earnings cyclicality, which is basically none. This is basically a secular growth business. Don't know if once they started earning money, I don't think they really had much of a down year. Let's check real quick. Shorten this up just a little bit. There's a couple weak years, but I mean, for the most part, if you bought this stock 15 years ago, you're very happy right now. More recently, it's one of those stocks where when I started developing strategies, I had a pretty big value tilt for most of the time since I really would have been active, like writing about stock investing since 2015. If you look at Salesforce's history, they've had like 100 PE, very, very high. So it's never really been, I mean, I knew it existed, it was on my radar, but it was always so far away from potentially being a buy using the methods that I used for most of this time. I do have a growth strategy now, which is what I used to track Salesforce with. But, we had the thing is, like, for my growth strategy, I want something that can 5x or 10x over 10 or 15 years most of the time. And this is a $200 billion company where it stands right now. So you have to wonder, if you look at, let's just even shorten this fast graph up a little bit. So you have to wonder that whether they're, whoops, that's not shorting it. What the ultimate limitations are. Ultimately, businesses' growth slows down when they get to be a certain size. So, especially if we're extrapolating that out for a long time with a really high valuation. But it was pretty interesting is that they actually did almost hit a buy on my valuation method during this trough last year. So I think I'll look at it here in just a second, but they got down at least, to a reasonable PE if you could count on the growth coming at some point, or continuing, I should say. And it was during a couple weak years where really we had this COVID bump, right? But other than that, I mean, the growth these other years was flat, basically. So it was slowing down. And then typically what you see is a stock have a multiple compress. And that's what happened when the multiple compressed from 63 down to 25 or so. And I was definitely interested here, but the question was the 32% earnings growth rate that they experienced from 2016 to 2023, which is where we were then, didn't look like it was going to be able to continue for another 10 years. So I have to take a stab in the dark and say, okay, what could these guys realistically do over the long term, and just make a kind of a guesstimate. And so what I did is I chose 15. I did have 20% down, but these couple of years were so weak earnings wise that I thought 15% made more sense when you consider that I'm extrapolating these earnings out for 10 years. Excluding this year, we see analysts in the future kind of in that same ballpark. So it's up to the individual investor how aggressive they want to be on their assumptions. I mean, I wouldn't tell somebody you can't assume that they'll grow 20% when they've shown they've been able to do it so far. Now, 20% is the maximum I ever assume for a stock when I'm analyzing it using earnings. So I don't go above that because I assume that eventually that earnings growth will slow down. So 15% is what I assume when I was watching this one, and I did almost end up buying it, but I did not there. And then this year we've had kind of an unusual bump. I think I didn't look into this real closely, but it's with most of the tech companies, they cut a lot of costs, and they were able to cut a lot more just in general. Like I'm thinking of like Alphabet, even Microsoft did some cutting, but they were able to trim a lot of fat this past year, and I think that probably helps contribute to this giant jump in earnings. So this is kind of a question mark too, but because this year isn't complete, and we don't know how it's going to end up, and it's a very big jump from last year. So I'm being a little bit careful with this one right now, and really my strategy is let's get this year finished. Let's get into like January, February. Let's get this full year final earnings number in. And then after we get that, we can go with like a 15% earnings growth assumption, and then we'll do the valuation that way. Between now and then, I am still using like a recession assumption. So that's another thing to take into consideration. We haven't had a real recession in a long time since these guys were a lot smaller business, so we don't know how that's going to go for them. And really, you just have to try to, for me anyway, using the methods that I use, I just want to make some decent general assumptions, and then if it gets really cheap, which it almost did here, I mean, reasonably cheap for a growth business, then I would be willing to take a chance. So I'm just trying to basically be a little bit careful, make reasonable assumptions, and then that's what I'll kind of show you here. Now there are a couple things going on here. So for now, basically, if it looks like the market's turning down, if they miss earnings maybe going into next year, like between now and the end of the year, this is kind of what I'm using as my guidepost, which was the 2020 recession, and a 15% earnings growth rate. But I think I'll probably get a little bit more generous as we actually get this year's numbers fully in. We start looking to next year and get some guidance. At that point, I'm thinking a 15% earnings growth assumption over the long term for 10 years. And then we'll see where that comes out. Now, right now, using this earnings growth assumption, the buy price would be about $162, which is only about 25% lower than where the stock price is now. So I think once we got into the new year, if things worked out okay and things are kind of on the trajectory that everyone expects, I would expect this buy price to hold. But there are definitely big question marks about what a recession would do to their business. So if it looked like if earnings were going to fall, I might stick with this more conservative approach here. And even the more conservative, which I think this is, I think for that I just used, it says 2020, but I think I actually probably used this. So it's really using this 2022, the trough that came down from there, I think. Or it could be this decline here. Not sure. Maybe I should check it. Let's see what I have. Depends on what so we are looking at a 23 PE. Yeah, so this was the 22 decline is what I was looking at. So it basically would use this as a guide, and then we've had this extra earnings growth. Now, right now, I'm actually using this as the peak earnings because I don't know for sure if they're going to actually hit these earnings. But if we look at it, if we were to use the 8, let's say they make the 805, okay, for the recession number, see, it would almost be a buy already. And so it's a little weird, and that's why I am being more conservative here, to have this big spike in earnings and then have a recession risk so close to it, and also have this trough that we're coming off of. So the whole dynamic, and it's because of the boom bust of the economy, of the pandemic stimulus and all that stuff. So we know things are a little bit wonky, and I'm being a little bit more cautious. I think once we get into next year, like I said, if earnings hold, this 162 buy price is probably kind of in the range that we're looking at, unless everything's falling off of a cliff or whatever by then. And then we have this other one to look at. So, but I think right in this range is probably a decent price if you think that they can get that 15% earnings growth rate over the long term. Sometimes on stocks where I don't really know for sure how things are going, I'll include a momentum factor as well. Right now that's good, but it might not be good when things start selling off. So I just try to kind of hodgepodge things together a little bit when I'm unclear, or maybe just don't have a lot of confidence in the individual future, the individual growth, the macro, the way that my method is kind of dealing with this whipsaw of the pandemic stimulus bust, and then immediately this is really unusual actually, this kind of jump in earnings, and so that just generally makes me more cautious, and I'll just take my time. I don't feel like I'm gonna really miss out on anything. It's not like super duper cheap even with these earnings assumptions. And so I wouldn't expect it to just like run away and never come back. But you never know. I generally think that caution is the way to go. So sorry I don't have like a better grasp on this one, but it's a pretty unusual stock, really. They just have a lot of different, most of the unusual things are like good, but when they've never really been tested in a recession at the size of a business they are now. When you're a young business and you're small, you can grow through a recession because your addressable market is so much bigger. But when you get to be $200 billion and you haven't gone through a recession as a big company like that, it can be very different. So I do think it's very possible that investors could be really surprised with like 2024 earnings just coming in significantly negative, and that would probably crash the stock price. So that's the danger, that I don't feel like I'd need to rush in until you kind of get some more information. All right, if you like this video, hit the subscribe button, and if you have a request, put it in the comments section, and I will get it on my list, and I will share how I'm thinking about it, even if I don't have like the greatest, clearest take. This is sometimes you just, in real life, you have stocks that don't really fit exactly right the way that you want them, or you have all the information that you would like, and I think that's the case with Salesforce. So I will see everybody later.